Mortgage rates are scheduled to rise in all of 2022, and in this video we are going to explain exactly why. My name is Jacob Sheets, and here for everything Milwaukee to Madison real estate, and also bringing on Ethan Brooks, mortgage extraordinaire with Fairway Mortgage, to help explain why these rates are going to be so volatile and what is causing those increases that we're seeing in the market right now, and if they're going to continue. So, hello, Ethan.
Excited to be here. This is a very interesting, unprecedented market. I saw a post that said, I would just love for 2022 to be precedented. So we'll see what happens.
Very good. So then you were saying, we were just talking previously for a little bit about how mortgage rates, they are increasing now. Record-wise, it's still pretty darn low, floating around that kind of 3.5-ish range for most conventional rates. But as they're increasing, there's talks of, inflation is happening, all these changes are happening, tax changes. There's a lot of confusion. So we have you to explain to us, kind of step by step what is happening. So please let us know what's going on.
We'll hop back in the time machine to the beginning of 2020 when COVID first hit. Right when COVID hit, there was fear and uncertainty in the market. Nobody really knew what was going on. And the Fed stepped in. The Fed is a paragovernmental economic committee that has a long and debated history of how helpful it's been, I'll say. And the Fed was born to prevent, effectively, runs on the banks, where the street got so concerned about the economy that they would rush banks and try to withdraw all their money. That was the root of the problem. That's what they're here to solve. So the Fed stepped in 2020, as is their job, and they started buying mortgage-backed securities. The government was effectively buying mortgages from the institution that normally sells them to Wall Street.
And that's basically to keep everything afloat, right? That was the plan.
Yes. So basic supply and demand states that if demand increases, then prices go up. The value of the desired object goes up because there's more demand for it. So the Fed was artificially increasing the value of mortgages, which kept mortgages stable and in fact caused rates to go down. So in an already unprecedented time, we also saw unprecedented mortgage rates low.
And that basically brings us from 2020 and COVID beginning into now 2022, right? That's the history behind it all, and then also it brings it to how low it is now. So then now you're kind of saying, what's next?
So the danger with stepping in and getting involved whatsoever is that the Fed ended up buying over $1 trillion of mortgages. $1 trillion. We almost go numb to the T word by this point. And they've spent so much money, they have all these mortgages on their books. And this, along with the stimulus programs, were inflationary. So inflation is the big bad boogeyman of last year and really this year, and we'll see for how long in the future. So the value of mortgages plummeted steadily over all of 2021 because investors were concerned about what would happen to mortgages. So it all ends up trickling down to the consumer, where Wall Street is saying, I think inflation is going to keep going up and it's not going away. And this bond that I'm buying for $100 is going to be worth $90 next year. It's a terrible purchase, and who knows if that value is ever going to come back. So they want nothing to do with it. They're actually selling off what they have, and then the value starts to plummet. Mm-hmm. And as the value starts to plummet, then that investment becomes less attractive. And so to make the attractive more sexy, then rates go up. The yield offered to investors goes up. So that's their monthly, quarterly, annual dividend for holding on to this bond to make the whole investment more attractive. And when the mortgage rate goes up that investors get, so does the consumer. Your everyday buyer, yours and my mortgage rates go up as well.
Perfect. And I think that you also said that you had prepared something for us too, to kind of show more of the visual side of how that happened.
As with a lot of things, history is cyclical, right? Not that it necessarily repeats itself, but hopefully we can learn from the mistakes, or I suppose good choices that our predecessors have made, right? So the Fed, which I have nicknamed the Supreme Court of Finance or economics for our country, votes in chairs over the years. And so in the past, we had Burns, Volkner, more recently was Alan Greenspan, and now we have Jerome Powell. And each time that they were in charge of the Fed, that they were the chair, inflation did some crazy stuff. And this was back in 1980. Inflation went from 7% to 14%. That led to a rise in rates. And Volcker came in and he was tough. He raised the Fed rate from 11% to 20%. The Fed funds rate is the rate at which the banks borrow money. It does not directly correspond to mortgages, but it impacts car loans, student loans, home equity lines of credit, your CD rates, the rate that banks get their money from the government.
Right.
Every time that the Fed has raised rates, though, it kills inflation. So more recently, within the last 30 years, Alan Greenspan faced a similar issue. And the consequences, however, of raising the federal funds rate is that it leads to a correction in the S&P 500 and or a recession. So Jerome Powell is our current Fed chair. And we just saw inflation go up from 1.75 to 7%, which was not what we saw the last time this happened, but 2 times ago. And mortgage rates correspondingly went up 4%. So actually, what we can expect then for mortgages is the opposite, where until the Fed funds rate is increased, we can expect and presume that mortgage rates will continue going up as they have, based on the causes that we already talked about. But then, once the Fed funds rate goes up, inflation should drop, mortgage rates should drop, and unfortunately, that would then, historically speaking, lead to a correction in the S&P 500, as well as potentially a recession. Historically speaking, this is not necessarily new. Based on what previous Fed chairs have done, we have a model for how to slow down, stop, and correct inflation. We can maybe expect what's to follow, unfortunately. But then also, historically speaking, we've made it through that too. So buckle your seatbelts for 6 months. And what this means then for buyers that I'm talking to right now over the next 6 months is that based on what we're anticipating, we would recommend that you choose a higher interest rate. So any buyer at any time can choose based off of a menu which rate that they want. You can choose a higher rate, and then I, as the lender, can give you a credit of interest at closing. Your monthly payment goes up, but your loan costs are sometimes even completely wiped out. Mm-hmm. That's a great short-term solution if you're staying in your house for 3-4 years, or if you expect that rates are about to go back down again.
Very good. Well, thank you, Ethan, for popping on here. And if you want to get to know us a little bit better, we'll have a couple other recommended videos that are right up above us here. And if you also want to schedule a meeting with either one of us, we'll have our Calendly links directly below that will be in the description. So if you want to schedule an appointment to learn more about the rates for 2022, get your home search started or anything like that, go ahead and directly book something on our calendar below. And of course, would you like to like the video if you got any value from this, subscribe to the channel, and of course ring our notification doorbell right there so that you can be updated as soon as we get a new video out. So again, thank you so much for watching, and until next time.